Welcome back to Investing Talk podcast. Today we're focusing on an analysis of GRRR Technology Group. This is a really fascinating company. The sources you shared, they show some just jaw-dropping revenue numbers.
Yeah, it's a classic high-stakes situation, isn't it? And that's why we're really digging into it today. The main question really is whether now is a good time to buy this stock. We've got this truly explosive growth momentum on one side, but then there's this lingering kind of difficult challenge around consistent profitability, specifically the official IFRS numbers. The market hates that kind of inconsistency, so figuring out the real story here is key.
Exactly. And we want to help you get informed quickly on this one. Before we jump into those numbers, just a quick reminder, please hit subscribe, like the show, leave a comment if you find this useful. And yeah, definitely if there's a specific company you'd like us to look into next time, just drop it in the comments below. We really do build these discussions around what you want to hear about. Okay, so let's unpack the bull case first because, wow, those revenue figures, they're almost hard to believe. Looking at the first half of 2025, the company reported revenue of $39.3 million. That's a 90.2% increase year over year. That's nearly doubling the business in just 12 months. What's driving that kind of speed?
Well, what's really interesting here is that this isn't just like one lucky contract win or something. This growth was really broad geographically. It suggests that their products are actually hitting a real need across the globe. Our sources point out this growth covered key places like the U.S., the U.K., the Middle East and North Africa, MENA, South America, and Asia too. When you see growth that's that fast and that widespread, it kind of suggests their AI solutions are meeting some critical, varied global needs.
Right, and we saw some specific high-value strategic wins that helped fuel this, didn't we? Moving them beyond just niche markets. In August 2025, they secured major contracts. Port of Time in the UK, right? And two big Taiwanese players, one Highport and ADE Corporation.
Yeah, and these aren't just, simple sales. These are strategic infrastructure deals. The focus was on things like high-end AI-powered surveillance for ports, and maybe even more telling, capabilities for analyzing criminal financial flows. Now, that's high-margin, high-security, really high-tech work, puts them squarely in that integrated security space, which usually gets a premium valuation.
And those specific high-profile wins, well, they lead us straight to maybe the most staggering figure in all the source material.
The pipeline, yeah. Those contracts helped push their total potential project pipeline value to exceed $5 billion, that number. It's almost hard to grasp because it's just so massive. It really suggests there's this huge untapped market out there that they've successfully managed to bid into.
$5 billion in potential business.
Yeah.
Yeah, that's absolutely game-changing. But I guess the key word there is potential, right? A pipeline's only as good as your ability to actually deliver on it.
Precisely. And execution, well, that needs capital. It needs runway. The market often discounts these huge pipelines if the company doesn't look like it has the cash to, hire the people, buy the gear, or just handle the inevitable project delays. Which brings us neatly to their balance sheet move.
Right. Speaking of capital, in July 2025, they basically secured that runway, didn't they? They completed a massive $105 million equity offering. That sounds like a huge vote of confidence from investors. They must believe the company can actually convert that pipeline.
Oh, it's more than just cash in the bank. It's really transformative for their financial structure. They immediately used that capital to seriously strengthen the balance sheet. They actively paid down their existing debt. Specifically, the sources say they cut debt by $3.3 million, dropping it from $21.4 million down to $18.1 million. That kind of move signals maturity. They aren't just burning cash chasing growth at all costs. They're actually shoring up their foundation. That's a key indicator of management discipline.
Okay, so that paints a pretty rosy picture. 90% revenue growth, these high-value contracts, a $5 billion pipeline, and now a $105 million cash cushion.
Right.
But here's where it gets really interesting, right? Because we have this massive contradiction. How can a company growing this fast, one that just raised all this cash, still report an official IFRS operating loss of $9.1 million for the exact same period? This is the profitability puzzle you mentioned.
This really is the heart of the investment debate here, and it forces you to ask a critical question before you even think about buying this stock. Are we looking at genuine, stable operational health, or are they maybe masking some systemic issues just with top-line growth? For these high-growth tech firms, you often have to look past that headline statutory loss. You really need to scrutinize the adjusted non-IFRS metrics.
Okay, but what are those adjusted metrics actually adjusting for? Because for the average investor, that IFRS loss, that's the official number, right? The one they report for tax purposes.
Yeah.
What's being stripped out to make the operational picture suddenly look positive?
That's absolutely crucial context. So when a company like Gorilla Technology reports positive adjusted EBITDA, that was $5.7 million, and positive adjusted net income, also $5.7 million, what they're typically doing is stripping out non-cash expenses that IFRS rules mandate they include. The two biggest adjustments are usually amortization of intangible assets, think goodwill from past acquisitions, and critically for fast-growing tech firms, massive stock-based compensation, or SBC.
Okay. So basically, the non-IFRS numbers are meant to show the cash health of the actual day-to-day operations, ignoring the non-cash costs tied to, like, building the company itself, paying employees with stock options, rating down the value of past deals over time.
Exactly. The core business, using those adjusted metrics, is shown to be cash flow healthy. But the official IFRS numbers, they're clearly still in the red. Just look at the per share numbers to see the difference. The basic loss per share was a pretty heavy $0.43 on that IFRS basis. But their adjusted earnings per share actually reached a positive $0.29 on the non-IFRS basis. This gap, this difference, that's the entire investment story right there. It's a transition narrative. They're asking the market to value the core operations based on that non-IFRS performance, and they're betting that the statutory profitability will eventually catch up.
And as if managing that internal accounting transition wasn't tricky enough, they got hit by a really brutal external factor in September 2025, something that just blew a huge hole in their official reports.
That's right. The sources flagged significant foreign exchange headwinds. They recorded a painful $12.6 million in currency exchange losses, and this was primarily linked to the rapid devaluation of the Egyptian pound.
Wait, hang on. Let me stop you there. The IFRS operating loss was $9.1 million.
Yeah.
But the currency exchange loss alone was $12.6 million. So that means the currency loss itself is actually bigger than the entire reported IFRS operating loss.
That is the huge, often missed insight here, and it completely reframes that profitability puzzle we were just talking about. If you mentally add back that $12.6 million FX loss, it strongly suggests that operationally, even on an IFRS basis, before accounting for that unpredictable global currency mess, they were actually running at a profit. That $12.6 million hit from the Egyptian pound, it isn't really a reflection of poor execution or bad product pricing, right? It's a macroeconomic event. Now, it definitely highlights the volatility baked into their global expansion strategy, particularly in emerging markets. But it also kind of validates the underlying strength of the core business model, paradoxically enough.
That makes the profitability question much less about the core tech itself, and far more about how they manage geographic risk, especially currency risk. So, connecting this back to the bigger picture then, why are they still winning these big contracts, despite these risks being apparent?
Well, their competitive advantage still seems very strong, mainly because their solutions are so diverse. They're not just a one-trick pony. Their offerings cover things like smart building management, integrated security systems, specialized policing solutions, and even general Internet of Things applications. This diversity lets them keep a strong market position, which is probably why that $5 billion pipeline is so robust. They can tailor solutions across a whole range of different industries and needs.
Okay, let's shift gears now and look at where the stock actually stands today. Because analysts, well, they seem generally pretty bullish, despite all the financial complexities we've just discussed. They've apparently raised the average one-year price target to $37.23. That gives the stock an overall bullish rating of 8 out of 10, according to one source. That sounds like a strong fundamental endorsement.
Analyst optimism is one piece, yeah. But if you look at the technical signals, the picture gets a bit more mixed. Technical indicators are flashing some caution signs. For instance, general market sentiment, often tracked by the Fear and Greed Index, is currently leaning bearish, around 39. And maybe more directly, the stock's moving averages are currently suggesting a short-term sell signal.
So you've got the technician saying, hold on, momentum might be slowing down here, but the fundamental analysts are looking past that, focusing entirely on that massive $5 billion pipeline and the future growth potential.
Exactly. Technicians often focus on the now, the price action, while fundamental analysts are trying to value the future. But what's interesting, and might reconcile those views somewhat, is looking at institutional ownership. We're seeing a positive shift there. Institutional ownership seems to be increasing. Big funds, the so-called smart money, they appear to be quietly accumulating shares. That usually signals growing longer-term confidence from major players who likely believe the company will successfully make that transition to showing consistent statutory profits.
Looking ahead then, what are the critical near-term events? We've got some key catalysts coming up in the next 3 months or so that could really swing the stock's direction. The biggest date on the calendar seems to be the Q3 2025 earnings release, expected sometime in November 2025.
Oh, absolutely. That release is going to be watched incredibly closely. Investors will be laser focused on two main things. First, can they keep up that exceptional, roughly 90% revenue growth trajectory? Any slowdown there would be punished. And second, maybe even more crucial, are they showing clear signs of effectively converting that huge $5 billion project pipeline into actual realized revenue? That conversion rate, that's the ultimate proof point needed to justify the high valuation the analysts have put on it.
And I imagine, given that dramatic currency hit they took from Egypt, the market's going to be hanging on every word from management about risk management.
Definitely. The market needs clarity. How does management plan to navigate or ideally mitigate future foreign exchange risk, especially related to those operations in volatile emerging markets? If they can't really control the macro environment, which they probably can't, they need to show they have a clear hedging strategy or some other plan to protect the bottom line from those kinds of shocks.
Okay, so beyond the official earnings reports, there's always that speculative buzz, right? Stuff that can act as a sudden catalyst. What are the current rumors floating around?
Well, there seems to be significant speculation about potential large-scale contracts, things like smart city projects, major security infrastructure deals. Particularly, the chatter seems focused on the Middle East and Southeast Asia. Maybe something materializing in Q4 2025. Given the high-profile nature of their recent wins, landing just one of those mega projects could massively accelerate the timeline for turning that $5 billion pipeline into reality.
And with that freshly fortified balance sheet, that $105 million war chest they raised, I guess corporate action is also being talked about. Acquisitions, partnerships.
It is. Market watchers are speculating they might use some of that cash to pursue targeted acquisitions, maybe buy a smaller company to quickly expand their tech portfolio or get a foothold in a new region. Alternatively, we might see them enter into some kind of strategic partnership discussion with, a larger tech firm, thinks maybe a Cisco or an IBM. Companies that might want to license Gorilla's AI security capabilities to enhance their own enterprise offerings. So bottom line, this stock really appears most attractive right now for longer-term growth investors, people who are comfortable with some volatility and willing to wait for the promise of that huge pipeline to hopefully materialize over time.
Okay, so let's try to summarize the investment thesis here. Gorilla Technology Group, it seems clear, is at a really critical inflection point. It definitely has strong revenue momentum, a differentiated product set, and importantly, a healthy capital cushion now thanks to that big equity raise. But improving profitability, specifically bridging that gap from adjusted profit to actual statutory IFRS profit, and effectively executing on that massive $5 billion pipeline, those are absolutely critical steps needed to validate its current pretty high premium valuation. The company has the potential to be huge, no doubt, but the path forward looks complex.
And that complexity leads us right to the final provocative thought for you, our listeners, to consider. We established earlier that the core business, if you strip out those big foreign exchange losses, was actually running close to, or maybe even at, an IFRS profit level operationally. However, given the company's own stated reliance on those non-IFRS metrics, those adjusted positive numbers to define its current health, how confident should investors really be in that underlying operational strength until the company can consistently bridge that gap, until they can demonstrate steady statutory IFRS profits while also successfully navigating the inherently unpredictable swings of global foreign exchange markets? It seems like the ability to manage macro risk has suddenly become just as important for this company as its ability to manage its sales pipeline, something to definitely think about.